first of all, thank you everybody for good afternoon. Thank you for taking the time to listen to our presentation. I'm Louis Hall, CEO of Cerillion, which I founded way back in 1999 as an MBO from Logica, which was a UK software house, and around that time was briefly in the FTSE 100. Oliver, do you want to do a quick introduction?
Yeah, very quickly. I've got a bit of background noise here at the moment. I joined Cerillion coming up 20 years ago. Prior to that, other sort of similar companies, and prior to that, PwC.
Thank you, Oliver. So, having completed the MBO, we then went out and raised private equity funding to redevelop the product set and the latest technologies, grow the customer base, build the sales marketing team, and so on. And over the time since then, we have continuously redeveloped the product set and added new functionality and new modules as customer and technologies and customer needs have evolved. So today we have around 90 customers in, at last count, about 44 countries. These are very sticky customer relationships. Over 70% of our customers have been with us for more than 5 years. Typically, our customers are with us for at least 10 years, and some customers have been with us for over 20 years. These customers are really important to us because they generate in any given year more than 70% of our revenue. So we're not very dependent on having to win new deals each year to keep our growth moving forward. And in most years, that figure is quite a bit higher than 70%. In the first half of financial 2021, which is our last reported set of figures, that number was at 71%, as you'll see from the pie chart below. Of that revenue, a little bit less than half of that derives from software licenses and support. A bit more than half of that typically derives from services, and those are mainly services around implementing our solutions. And a very small amount, so typically 3, 4, 5%, will derive from reselling software licenses, third-party software licenses, and some small amounts of hardware. And then geographically, typically about half our revenue comes from the European market. In the first half of 21, that was skewed quite a lot more towards Europe, but we'd expect that to return to historic norms moving forward. And the other half is split in different measure between the Americas and Asia Pacific. So we provide mission critical enterprise software to telcos, and we say the software is mission critical because it's software that telecoms companies have to be in business. This is not nice to have. It's essential. And if you look at the sort of functions that we provide on this slide, we cover everything from building the complex product bundles that telcos now increasingly sell. So if you look at the stuff you see advertised on TV, these days telcos are selling bundles that include typically your home broadband, home fixed wire telephone, mobiles for yourself and family, and TV packages to TV channels. And I guess we just had a presentation on TV, so that's a big factor of telco business today as well. But of course, if you imagine for B2B, for businesses, that those product bundles can be even more complicated, and that's an awful lot of parameters to manage. So that's a key function. And then we provide the software that enables telcos to onboard their customers through our CRM package, and also to manage the services that they then have, but also to enable customers to onboard themselves and manage their own services through our mobile apps and online self-service applications. And we've seen a big shift towards this in the pandemic, obviously accentuating a shift that had been going on for some time. We then have a sophisticated module that connects all these services to the network. So once a customer has decided what services and what bundle, something has to translate this bundle of this product bundle into physical connecting stuff to networks. And we can be talking to easily a dozen network elements to connect one product bundle. So that's a complicated piece of technology. Once the services are connected, we have an online charging platform, real-time charging platform that monitors customers' usage of those services as they're being consumed, manages their balances, etc. And then our revenue manager module handles all of the billing, putting those charges onto bills in whatever form, handles tax, handles accounts receivable, handles payment processing, collections, and so on. So as we're short of time, I won't delve into a vast amount of detail, but this is a very broad, very deep set of software modules that telcos have to be in business. And then if we look at the delivery deployment model for this, this is an interesting change over quite recent times. So we've traditionally provided a perpetual software license to use our product modules, and we've then provided a support service which we charge a support maintenance fee. What we're increasingly seeing is that rather than have our software installed on our customers, telco customers' own hardware and their own premises, more of a move towards us hosting the service, hosting the solution for the customer in the cloud, and then operating that solution for the customer as well. So this is a really important trend, because this is driving a lot more, not just a lot more revenue, but a lot more recurring revenues. And obviously the shift from perpetual to term license, which is all we actually sell, all we offer to the market these days, is another big shift in terms of driving repeatable revenues. Another important trend that we've seen is that as we progress to sign larger deals with larger customers, so our sort of deal size and customer size is increasing, those customers tend to favor more as a service than on-premises deployment. Moving on to what's driving the market. So I guess the question here is, what is it that would drive telcos to either replace their CRM billing charging platforms or to upgrade one of ours? And there are really three factors. We haven't a lot of time, so I'll be quite brief on this, but essentially telcos need to grow revenue, so they've invested heavily in new network technology and equipment, and they need to find ways to package existing services into new bundles to increase the amount of value they can generate from them, but also to encourage customers to move to new services by innovative bundles and so on. So there's a lot of stuff that our software supports in that area. And then of course business optimization is a key driver. Typically telcos have lots of legacy billing platforms, charging platforms, provisioning platforms, etc. And if you can consolidate those onto a smaller number or a single one, then that is a big, huge saving in OpEx. And a number of our transformation projects recently have been driven by that force. And then of course technology is a big market driver. So new technology in the network often means upgrades to software or wholesale replacement of legacy platforms. But it also just drives investment. So in general, so the current huge investment wave in 5G, but also in fiber to the home, is driving more investment into telco. And if you're spending billions on 5G rollout, then a few tens of millions or 100 million on the ancillary system to support that network becomes a relatively obvious budget decision. So there's a trickle-down effect coming from huge technology investment. And then I'll just move on to talk about the market segments we address. So we essentially provide our solution to tier 1, tier 2, and tier 3 telcos. To the tier 1s, we tend to address niches. So for KDDI in Japan, for example, they're one of Japan's largest telcos. We provide one of our core modules, our network inventory module. So there's a kind of niche play with a single module rather than the full suite. To Proximus, which is like the BT of Belgium, we provide our full suite, but to one of their challenger brands, one of their MVNOs, but we don't provide our full suite to the whole group. For the smaller tier 2s and some of the tier 3s, we tend to provide the full suite. So that could be a smaller national operator, like the national telco, the former PTTs in places like Malta, Gibraltar, Isle of Man, and so on. But also we provide our solution to we can address a very diverse range of telcos. In fact, pretty much any telco or communications company can use our software. So, for example, Norlys, which you probably won't have heard of, is the second largest power generator in Denmark, but has also built a telecoms business and is now the second largest provider of TV and broadband services in Denmark. So there's an example of a not household name tier 1 telco, which is now a very large customer. Moving on, I'm conscious of time, so I'll continue to try and summarize as much as possible. In terms of the competition, just a few words on the competition. There are essentially 3 groups of competitors that we face, and we group these into the large independent software vendors, so companies like Oracle, Netcracker, and so on. And these players tend to offer frameworks from which they will build a quite heavily bespoke solution. Whereas our big differentiator is we provide a product, it works out the box, you can turn it on and look at it on day one, it's demonstrable on day one across a whole range of business cases, use cases that the customer might want to throw at it. And that does give us an advantage. In a world where I think telcos are increasingly thinking that, whereas even 5 years ago, it would be, as a large telco would think nothing of investing 100 million or 200 million or 500 million building a bespoke solution to do CRM, charging, billing, collections, etc. Today, with the software as a service trend, we're seeing telcos actually moving more towards product solutions that are much quicker to implement and are much cheaper to implement. So the large ISVs are typically looking to deploy teams of hundreds of people over 3 to 5 years, whereas we're deploying small teams to put our software into use in sometimes as little as 9 to 12 months. So that's quite a contrast. And then we have the equipment vendors, network equipment vendors. So Huawei, ZTE out of China, and obviously they are shut out of some of our key markets at the moment, which is very positive from our point of view. And then we have Ericsson, who have a competing software suite. Again, they tend to be working from a framework of products which have to be put together separately each time. Quite a lot of stuff in their suite was acquired through acquisition. So products that weren't in the first place designed to work together, whereas ours were all built from the ground up to work together. And again, we can be more flexible, we can be quicker to market and much lower cost. And then there are some smaller independent software vendors of the same order of magnitude as size of us, but they tend to be more focused on particular specific verticals or particular geographies. So moving on again, in terms of the highlights, business performance numbers, the latest results we have are the first half of 21, our year ending in September. So we'll be reporting on our final results in November. But in the first half of 21, we had the best ever first half in our history, and that was driven by increasingly signing larger deals with larger customers, and these revenues flowing through. New orders in the first half were up 148%. That pushed our back order book up by 74% to 42.1 million. Contrasted with a consensus forecast of 25.3 million for the full year. That gives a lot of confidence in the future. And I think also we're pleased that the growth, the big increase in growth that we saw in the first half of 21, where our top line growth was over 20%, which is double the historic 9 to 10% we've achieved in the past. And consensus forecast suggests that would be that greater than 20% growth would continue through to the full year. And finally, before I hand over to Oliver, another really important factor in our business performance has been the bigger increase in recurring revenues. So our annualized recurring revenues in the first half of 21 grew by 43%, which is more than double the rate of overall top line growth. So very pleased about that trend as well. So I'll hand over to Oliver, who'll talk about the KPIs and some of the other financial aspects.
But we haven't got much time, so I'm just going to pull out a few bits of information. Just to reiterate, the company started up in 1999, floated in 2016. Prior to that, we were in PE, private equity land. We are a company which is used to and has got the discipline of making profit, generating cash and paying a dividend over the whole of that period, not just since IPO. Which I think is an important criteria in this day and age. You can see, as Louis stated earlier, all the numbers are going up in our key KPIs here. These are the half-year results till March, as Louis said. Full year results in November, though we should be due to make a sort of a trading update in mid-October prior to that as well, with our September year end. Revenue up, recurring revenue up, which is a key one for us, being driven by managed service on the top right-hand side, plus support as well. And this is primarily being driven by the fact that we're winning larger clients who have larger budgets, and are seeing more and more with the product we're offering for us to actually run it day to day. Also, the other one to highlight here is the net cash. You can see is going up at September 2020. I think there's actually a one out. I don't know, see the half year numbers, 7.7 million. That's that is net cash. We actually have no borrowings at all, and you can see the progressive dividend policy we have as well. Do you want to go to the next, Louis? This, without the tablet, is the 9 KPIs. This is just giving some overall financial highlights. New orders, as Louis indicated, some very large new contract wins, 23.6 million in the first half of this year, against 9.5 million the year before. The back order, which includes contracted but revenue not yet recognised, 42 million pounds. That really underwrite the next period, giving us certainty, allowing us to recruit more staff, invest, knowing that the revenue is there to burn. There's a breakdown. I won't go into too much more detail here of the revenue breakdown. The software, which is the support and the license, is the area where we see potential. Well, not just potential. We are seeing additional growth. Customers buying effectively the same product, but a larger number of subscribers, a larger license, and larger support fees. That leads to operational leverage, which you'll see in the next slide. Adjusted Ebitda margin very healthy at 38%, and you can see the net cash at the bottom of the page. Next slide, Louis. That is the P&L for the half year, which is just really reiterating the same points we've drawn out. Gross profit margin, we've been budgeting for it to be in excess of 70%. We've actually seen it heading towards 80% during this period. I think we got there a bit earlier than I thought in terms of that. I prefer to be forecasting a mid-70s margin, but in due course, I see the operational leverage taking us towards that sort of number. There are a small amount of finance costs at the bottom, but that's just to do with, if anyone's familiar, IFRS 16. It's not. There's no debt left to pay now. Tax rate historically has been low due to R&D tax credits being used. See that going up to an effective rate of 10% plus in due course as the profits increase. Consolidated balance sheet, nothing very much on here. There's a number of intangibles arising on the IPO, acquired intangibles, which are a non-cash item. But the key thing here is cash in bank, no borrowings, and really demonstrates a sort of a close proximity of P&L to cash generation. Next, Louis, and that's just a consolidated cash flow statement. I won't go through it too much more. We do have a track record year on year of generating cash. Okay, Louis, back to you.
Great, thanks, Oliver. I appreciate we're probably at the end of our time, but very quickly, just a quick look at the sales pipeline. We haven't really spoken about sales figures. The sales pipeline grew in the first half of 21, and I think if there's not an exact science about sales pipelines, but a total unweighted pipeline of 131 million. Again, set against a consensus forecast of 25.3 million for financial 21 gives us at least a reasonable degree of comfort. And then this is some more detail on how that pipeline breaks down, where we were looking at around just under 17 million of sales pipeline at preferred supplier stage, where we're selected, but we're in the process of contract negotiations and so on, and about 14 million of sales where we're shortlisted, which is typically the last 2 or 3, which we'd expect to win, probably at least 1, sometimes 2 of those, that kind of order. So it's a little bit more color around the what gives us confidence in the numbers looking forward. We're short of time, so I won't dwell on this. And really, that's it. We're seeing very important trends towards larger deals, larger customers. We're seeing our top line growth rate more than double at the moment, and we're seeing our recurring revenue, share of revenue, grow much faster than the faster growing top line growth. So we feel very confident about this inflection in the business at the moment, and yeah, we're looking forward to some great progress in the future. Thank you very much.
Thank you very much indeed for joining us, and we are quite tight on time. We do have a lot of questions, so again, apologies if I don't get a chance to ask your question at home. First off, could you talk through the impacts to revenue and EBITDA, the result of switching away from perpetual licenses to a SaaS model?
Would you like me to take that, Louis?
Yeah.
Yeah. Okay. Okay. We have moved away from perpetual to, as opposed to SaaS, we've moved over to a term license, which is in the main a 5-year term license. We're recognizing pretty much in line with previously the perpetual, because it's a core product, and we pass all the tests and we have to abide by the accounting rules of PwC, who are our auditors. We have to recognize that up front because the customer has the right to use this, etc., etc. They're contractually bound. We don't have to do any more work, etc. So not a lot of change in that respect, except that, and this is the bit we don't really reflect in our numbers at the moment, because of the term. 5 years down the line, we're going to get another purchase in the majority of our customers. The majority of our customers stay on board for 10, 20 years, so they're going to be buying again. So the biggest implication for us is additional revenue down the line, and we haven't got that in our recurring revenue at the moment, and somehow in this autumn presentation for this next full year, we've got to get those numbers in there to demonstrate we're actually doing ourselves a disservice there.
Yeah, we're understating the recurring, really.
And that's my next question. You mentioned 43% growth in recurring. What's the current overall percentage of revenue that is recurring?
It's now north of without those term licenses, it's now heading towards 35% without those term licenses.
Question, as it's one of our old friends, Brexit. You've got an incredibly international customer base there. Has Brexit had any sort of impact on the business, or will it in the future?
No, I think. Do you want to go on mute, Oliver? Just to the background. I think to date it hasn't. I mean, at the end of the day, there are no tariffs on software or services in the deal that was struck. So from that point of view, it isn't making a difference. I think obviously pretty much all businesses are constrained by labour shortage to an extent, and we've had to diversify our our team somewhat. So we announced opening an office in Bulgaria last week, and that's in part a reaction to the fact that there just aren't as many technology specialists in London as there were before. But because we can operate anywhere, and we have 160 people in India as well, with another base we can grow. And we are looking at growing in establishing a base in Latin America. We have the technology is a global business, and people can do it from anywhere in the world. So we're not really, we're not limited by that, I don't think.
And final question, I think, for time, although we do have very many more. How much is spent on R&D, and how much is budgeted for going forward?
Sorry, important figure is it's about 10,000 man days of effort. How that is accounted for is it can depend on which model one uses, but over to Oliver.
I was going to mention the same. We get at the moment we've got about 10. A lot of R&D. We've got about 10,000 man days, with quite a lot of it done out of our India office. Just about all the IPR inside the product, which has been 20 years plus, is ours. We own all of it. We're direct costs. We're spending about 1.5 million pounds a year. That being the direct salary cost. The opportunity cost of those same staff not then working on revenue generating is probably nearer to sort of 7-8 million pounds plus. Going forward, we would see that to be going up in line with the 20, without this being a forecast, 20-25% growth, which we're anticipating at the moment in the top line. We'd see we could accommodate that sort of level. And just the most important bit, I think, is we're capitalising about £1 million a year of that R&D. The rest we're expensing, about 2/3 of it, and at the same time we're amortizing about the same amount through the P&L account. So it's effectively washing its face. So there's no trickery going on. We haven't got any soft assets in that sense on our balance sheet, which is the most important thing.
Lovely. Thank you very much indeed, gentlemen. It's been really interesting. Thank you for joining us.
Thank you. Pleasure. Thank you, everybody.